Hello everyone. This week in week one, we're going to be talking about normal balances. And to me, understanding the normal balance is the key to understanding everything in accounting. So it's the foundation. And so if you can get the normal balances and understand them, everything else is just going to be so much easier. There's a little song on the internet called the debit credit song, I believe. I'm going to look that up and I'm going to post it in our classroom because once you get that stuck in your head, it's difficult to forget. And basically the lyrics are debit on the left, credit on the right. And they say that a lot. So that is the first thing to learn is debit on the left and credit on the right. You may be used to hearing credit in a different way or debit in a different way. But in accounting, it simply means left and right. And you want to try to forget any preconceived notions that you might have about what debit or credit means. You know, we all have a debit card. We're debiting our bank account. So it's withdrawing. You want to forget all of that, okay? And simply remember that debit means left and credit means right. And so the normal balance is the side of the account that is increasing. So in accounting, we have all these different types of accounts. We have assets, withdrawals, expenses, losses. We have liabilities, equities, revenues, and gains. And each of these actually have more accounts within them. But these are the basic types that you're going to deal with. And so when we make an entry in accounting, we either make the entry on the left or on the right. And depending on the normal balance of that account, the side that is increasing is the normal balance. So for example, for an asset such as cash, cash is an asset. If we want to increase cash, we would make our entry on the left, okay? If we want to decrease cash, we would make our entry on the right. And I simply know this because I memorized it. This is a little cheat sheet you're looking at here that I give out to students. When I first started doing accounting, I tried to learn the normal balances, of course, like everyone does. But I would second guess myself. I still, to this day, sometimes will stop and think for a minute. Is it left or right? But one of the things that I did that really helped me get it and helped it click, where I didn't have to constantly get my book and dig through and look it up and make sure that I was doing it correctly, because I second guessed myself a lot, as I'm sure many of you can probably identify with. So what I did was I went to Walmart or the dollar store or somewhere and I bought these little stickers. You can get them in the office supply store. Little tiny little stickers. They're just white little peel off stickers. And on my computer monitor that I'm actually looking at right now, and I was always looking at when I did my homework, I was always looking at my computer monitor. On the left side, I put stickers and I wrote asset, withdrawal, expenses, and loss, okay? And on the right side, I put stickers that said liabilities, equity, revenue, and gains. And whenever I was working on my homework and I was about to do an entry, similar to the entries you'll be doing this week, if I was second guessing myself, I didn't have to get my book and flip through. I just looked at my computer monitor. Oh, it's an asset. It's on the left. The left side is the side that is increasing if it is an asset. Okay, so that's just a little tip you might try. It really, really helped me. I also just made a flashcard in case I was out studying somewhere else. I would use it as a bookmark. I got a 3x5 card. On the left side of it, I wrote asset, withdrawal, expenses, and loss. And on the right side, I put liabilities, equity, revenue, and gain. So you just want to be able to very quickly look and see if you're correct in making your entry on the left side or making your entry on the right side. You want to very quick and easy way to look. Okay, I will post this little cheat sheet in the classroom. It has the accounting equation, which is assets equals liabilities plus equity. As an equation, it must always equal. That's one of our goals when you're doing your work, making sure that it continually equals. So that means if you make an entry on the left side, on the asset side, you have to also make an equal entry on the right side, or the liability and equity side. So this equation that includes assets, liabilities, and equity, it expands to include more sub-accounts. And we call this the expanding accounting equation. And it looks like this. Assets is equal to liabilities plus owner's investments minus owner's withdrawals plus revenue minus expenses. So the plus and minus signs in that expanded equation above, okay, notice they're green and blue. So we add owner's investments, that's going to increase. We subtract owner's withdrawal, that's going to decrease. We add revenue, that would increase, and then subtract expenses would decrease. And all of these accounts, owner's investment, owner's withdrawal, revenues, and expenses, they are all part of equity. So it's actually the equity part that really expands. Okay, we call it the expanding accounting equation. The basic equation is assets is equal to liabilities plus equity. But when we kind of open it up a little bit, we see that within equity, we have these other types of account. We have owner's investment, owner's withdrawal, revenue, and expenses. Assets are things like cash, receivables, supplies, furniture, buildings, and these are things that a business owns or they can expect to receive in the future. Accounts receivable is the account that we use when a customer buys something from you but then pays you later. They buy it on credit, right? But we know that in accounting, credit simply means right. But you get the picture. They're going to pay for it later. They might have used a credit card. It could be an old-timey store where people actually walk in and sign a book, you know, like we see in some of the old movies where they have an account and they just come in and sign for that, and then they pay at the end of the 30 days. So accounts receivable is a lot like cash, although it's not cash, but it is kind of next in line for cash, okay? And assets have a debit normal balance, or in other words, they increase with a debit entry. Liabilities are things that you owe, so the light bill, the credit cards, payroll, so anything that you have to pay. And if it ends in payable, the word payable, then we consider that to be a liability, and liabilities have a normal credit balance. And remember, this is just something you have to memorize, and memorizing this on day one will help you through all of your accounting classes. Equity consists of two basic parts. It's either money that owners put into the business, which we call paid in capital, they paid it in, and then money that the business earns over time, and we call that retained earnings. Okay, so money that owners put in, we call that paid in capital or owner's investment, and then money that the business earns over time, we call that retained earnings. Your paid in equity accounts are your owner's investment or capital, and your owner's withdrawal or dividends. The retained earnings equity accounts are revenues and expenses. Okay, so if we go back up here and look at our expanded equation up here, the owner's investment and owner's withdrawal, that's the paid in part of retained earnings. And then the revenue and expenses, that is the money that the business earns over time, which we call retained earnings. Okay, so actually I think I said that wrong. I want to correct myself. The paid-in equity accounts are the owner's investment for capital and the owner's withdrawal and the dividends. So up here, owner's investment and owner's withdrawal, that is your equity. And then the revenue and expenses, that is your retained earnings. Okay, so the first two portions of that expanded accounting equation, that is paid in equity, meaning that the owners just gave the business the money, or they paid it in to get it started, get it up and running. And then the second part, the revenue and expenses, this is your retained earnings. So we take our revenue, we subtract our expenses, and what is left, we call that retained earnings. It's basically what we earned and we didn't have to pay out for an expense. Okay, and I think that pretty much is it on the cheat sheet. These are really, really important, basic concepts that are very important for you to learn. Learning the different types of assets, the different types of liabilities, and then the basic parts of equity, and learning the normal balances of all the different account types. Okay, so I hope you found this helpful. I hope you will use some of the suggestions that I made about making the little flashcard or putting the stickers on your computer monitor on the left side and the right side to make it easy for you to double check yourself and so that you don't second guess yourself. All right, so this is for Module 1. I'm going to post this in the discussion, and I will post a little follow-up question for everyone to answer, and I will see you in the discussion.